Winning the Loser's Game. A Summary and Review by Charles Ellis. Hello and welcome to Data-Driven Decisions, the channel where we help you make smart choices with your money. In this video, we're going to summarize and review one of the most influential books on investing ever written, Winning the Loser's Game by Charles Ellis. This book was first published in 1975 and has been updated several times since then. It is widely regarded as a classic in the field of finance and has been endorsed by many experts, including Warren Buffett, Peter Lynch, and Jack Bogle. The main idea of the book is that investing is a loser's game, meaning that most investors lose to the market because of their own mistakes and emotions. Ellis argues that the best way to win this game is to avoid losing by following some simple and effective principles that he outlines in the book. These principles are especially relevant for beginner investors who want to achieve long-term success and avoid common pitfalls. In this video, we will cover the main points of the book and explain how you can apply them to your own investing strategy. What is a loser's game? The first thing that Ellis does in the book is to define what he means by a loser's game. He uses the analogy of tennis, where there are two types of games: a winner's game and a loser's game. A winner's game is when the players are so skilled that they can hit the ball wherever they want and win points by their own actions. A loser's game is when the players are less skilled and make many errors, so the outcome is determined by who makes fewer mistakes. Ellis claims that professional tennis is a winner's game, while amateur tennis is a loser's game. He then applies this concept to investing, where he says that the market is like a professional tennis player and most investors are like amateurs. The market is so efficient and competitive that it is very hard to beat it consistently by picking individual stocks or timing the market. Most investors end up losing to the market because they make costly errors, such as buying high and selling low, chasing fads, paying high fees, or trading too frequently. Ellis says that these errors are caused by psychological biases, such as overconfidence, greed, fear, and herd mentality. He argues that the only way to win the loser's game of investing is to avoid these errors and play a different game altogether. How to win the loser's game. The main message of the book is that the best way to win the loser's game of investing is to adopt a passive, long-term, and diversified approach. Ellis explains that this approach has several advantages over the active, short-term, and concentrated approach that most investors follow. Here are some of the key points that he makes. Passive investing means that you do not try to beat the market by picking individual stocks or timing the market. Instead, you buy and hold a broad portfolio of low-cost index funds that track the performance of the market as a whole. Ellis shows that passive investing has historically outperformed active investing because it avoids the errors and fees that eat away at the returns of active investors. He also shows that passive investing is more tax efficient because it generates less capital gains and dividends that are subject to taxation. Long-term investing means that you do not react to short-term fluctuations in the market or your portfolio. Instead, you focus on your long-term goals and stick to your plan regardless of the market conditions. Ellis argues that long-term investing is more rational and profitable because it allows you to benefit from the power of compounding and the historical trend of the market to go up over time. He also argues that long-term investing is more emotionally stable because it reduces the stress and anxiety that come from watching the market every day. Diversified investing means that you do not put all your eggs in one basket. Instead, you spread your money across different asset classes, such as stocks, bonds, real estate, and cash. Ellis explains that diversified investing reduces your risk and volatility because it lowers the impact of any single asset on your portfolio. He also explains that diversified investing increases your returns because it allows you to capture the performance of different segments of the market that may have different cycles and trends. Conclusion: Winning the Loser's Game by Charles Ellis is a must-read book for anyone who wants to learn the basics of investing and achieve long-term success. The book teaches you how to avoid the common mistakes and emotions that cause most investors to lose to the market, and how to adopt a simple and effective strategy that will help you win the loser's game of investing. The book is full of practical advice, historical data, and real-life examples that make it easy to understand and apply. If you are looking for a book that will change the way you think about investing and help you make data-driven decisions, this is the one for you.